time for Life and Money Matters with the Success Guys, Mike Hill and Renee Guerra. Changing lives one day and $1 at a time.
Welcome, KBEC listeners, to another edition of Life and Money Matters. I'm Jim Phillips, and in studio with me today is Mike Hill. Renee Guerra, unfortunately, is not going to be able to join us, so Mike's going to make up for his lost week last week when he was out in the soccer hinterlands with his daughters. So he gets to fly solo with me this week, and we're going to have a great show talking about how we can hopefully make your money and your portfolios a little bit fatter, gang. One of the things I want to encourage you as a listener, please give us a call if you've got any kind of question as it relates to money management. Mike is a professional financial planner, and he's here to answer your questions and be an asset to you. And the only way you can take advantage of that, quite frankly, is to give him a call here during the show. 972-923-1390 or 972-938-1390. And I would encourage you to do that. To that end, Mike Hill has a workshop on May 17th coming up at Navarro College in Waxahachie from 6:30 to 8 p.m. And as luck would have it, Renee has one at the same time at the same location. Both of them are talking about different tools. Mike's tool is women and investing. Not that you can go out and meet women at this thing, guys. This is about how women deal with financial issues.
I think that workshop's down the hall from ours.
Exactly. So women in investing. Listeners, please call us here at info or send us a note at info@kbec.com. We'd be more than happy to get you all the information on that. And Renee's workshop will be called Tools for Success. And it will be at May 17th at Navarro College, 6:30 to 8:30 as well. If you need more information on either one of those, please give us a call here at 972-923-1390. We'd be more than happy to share the information and let you know. And to that end, Mike, let's talk a little bit about where the money in our lives is headed and where things are going and what's going to happen come Election Day? Because I know there's a lot of people out there sitting there going, okay, if the Democrats get back in, then this is going to happen. If the Republicans get in, this is going to happen. And if nobody gets in, then it's Armageddon, and who knows what's going to happen. So what's the crystal ball tell Mike Hill?
Is there elections going on? I didn't notice. Is that what all those signs everywhere in every single yard are out there right
672 of them, it seems like.
Yeah, I like this question, Jim. This is very topical. I get this question all the time. Michael, what do you think is going to happen based on who gets elected, what gets elected, et cetera, and how it relates.
Let's hope what doesn't get elected.
What doesn't get elected. But we'll just leave that there. Not going to get too much into party affiliations. But it's real interesting. John Hancock, real famous insurance group. Of course, everybody knows about the John Hancock, bigness signature on the Declaration of Independence. He did that, by the way, because King George had bad eyesight, and he wanted to make sure that King George saw his signature. Not a lot of people. Everybody thought it was braggadocio. He did it because he really wanted him to see it. That's what he said, anyway.
Really?
I digress.
That's a great fun fact.
I digress. I read too many biographies. Anyway, the elections, they've gone back over 100 years, over 24 different elections. Presidential elections are what I'm talking about here. And what's interesting, and we're kind of following in line exactly according to the study. They came out over 100 years and said the best year by far for elections in the 4-year election term. You have the year like this year where we're voting, 2012, so 4 years ago would have been 2008. On average, in an election year, that is the best year for markets. The year of the candidate being elected, the only exemption, by the way, was 2009. Every year, every election, the year after the candidate's been elected, the market has returned a positive return. Every single time, except for 2009.
Really?
And then what's interesting of that is the post-election year and the midterm election year, years 2 and 3, happen to be the worst 2 years, going back 100 years, different markets, different wars, different et cetera, depression, boom, whatever it may be. Those are the 2 years that are worse for the market. So,
is there any variance as to whether it's a re-election if the guy comes back in, or whether it's
that, Jim?
And I didn't get set up for this.
No, you're absolutely. I get that question as well. What's funny is, or not funny, depending on what party affiliation you are, and this has nothing to do with party affiliation. The markets have a better year, no matter who gets reelected, when the incumbent stays in office. When the incumbent stays in office, the markets have averaged close to a 4.5% better return than a year where the incumbent was kicked out of office. Now, what could be drawing down those numbers, I hear a lot of Democrats, see, the market's going to be better.
Right.
You might want to remember 2009. That was the only year where an incumbent didn't stay in office and the market went down as well. So you can argue both sides. But the best year, this is what I found interesting, the best years are when you have a Democrat as the president and Republicans controlling the Congress and Senate. Those were all the best years. When you had one party controlling both, those were the worst years during any election years, Democrat or Republican.
Sure.
When you had it all your way, the markets didn't do as well.
Well, and again, if you think about what drives the markets, a lot of people, I heard an interesting comment the other day. 50% of the market is driven by speculation, 25% is based off of reality, and 25% is based off of hyperbole. And if you think about it, you know, the sky is falling, the sky is falling, the sky is falling. Everybody hears that, so you all of a sudden, I got to get out of the market, I got to get out of the market. But the realities 9 times out of 10 are the fundamentals have not changed, okay?
That's so funny you say that. That's absolutely, yes.
And how many times have we sat there before we've even gone on the air and had this conversation and said, okay, why is everybody investing now? Or why is everybody afraid of investing now? What fundamentally changed between Monday, Tuesday, and Wednesday? You know, there shouldn't be a fundamental thought process that says, I'm only going to invest on Thursdays.
Absolutely.
You know, you invest because you've done your homework, you understand what the fundamental of that stock is and where it fits within your overall portfolio. And it may not be a stock, it may be a bond, it may be, you know, any different
alternative investments, whatever.
Investments or whatever. But yeah, that's fascinating though, on the election deal.
When you said that about the election, you know, one is reality, one is this is my little theory because I get asked that question. Well, Michael, why do you think that is? Why do you think that happens during election years? And I think it's just point blank. Like right now, you have 2 candidates. We've narrowed it down to 2 candidates. And what do you do in election years? And I'm not accusing anybody of being, well, let's just say a truth bender or anything like that, but because I can't afford the money to go to litigation of one of them.
Right.
But we all know during election years there's a lot of promises made.
Sure.
So when you hear things like tax credits thrown around, or we're going to lower taxes, or we're going to increase spending in the healthcare sector, et cetera, all of a sudden, I don't know what happens, but every 4 years, all these people that invest go, well, they're going to lower taxes, so I need to start investing in things that are better for lower taxes. Or they're going to start making it easier to drill for oil, so I need to start investing in oil companies. But then, like I said, the year after elections,
reality
hits. Well, wait a second, they can't do this, and this. So I think that's also why we're closer right now on the Dow being up close to 8.5–9% for the year, because not just the elections, but I think we're also in the spring boom, and we've had some pretty good earnings in the economy going forward.
Best to April and then May stay, right?
Yeah, absolutely. April wasn't the best quarter we've had in close to 11 or 12 years on the Dow. Now, again, I come back, you know me, I don't do a lot of stock market investing. I think there's a piece of that in your pie, but I'm only 25–30% invested in the stock market for my clients, and we can go over that another day or today. But the main thing that I try to stress upon people is the Dow on 9/11, we can all remember that date, was right around 10,000. Here we are at 13,000, 11 years later, pretty much. So we've moved 3,000 or 30% basically in 11 years. And oh, by the way, how much antacid were you taking in those 11 years? You didn't even average a 3% return per year with all those up and downs if you were just a buy and hold investor.
And the reality is most people want an 8% return. 8% return means you double your money in 8 years.
Absolutely.
You know, and everybody would like to get to that. It obviously has not happened in this past decade. The whole concept of buy and hold, and we'll get into that a little bit later because you and I are on the same page there, that the buy and hold strategies that were prevalent in our parents' eras, the era of the mutual fund and all of those things, that strategy today has really been found to be flawed.
Absolutely.
You cannot just sit there and randomly put X amount of dollars into the stock market and expect it to, you know, infinitely go up and nobody have to manage your money or your times. What's the headline, though, on election? If you're an investor today, you're looking at the uncertainties of November, you're looking at the debt levels and all the rest of that. Is an election year really a good time to invest? What I heard you say is it is.
Yes, absolutely. Now, you need to know what sectors to invest in. And again, this is from John Hancock. You can get this research on their website, or you can go to Ned Davis Research. That's actually the company that does this for John Hancock. But they did this is going back to 1980. Because I didn't want to go back to 1900. Obviously, oil did really well from 1900 to 1930. It's called Rockefeller Center in New York for a reason.
Right.
But that was what was interesting, and I think you'll get a kick out of this, Jim. The number one sector to invest in from 1980 till 2008 in those election years was energy. Number 2 was utilities, and number 3 was consumer staples. Do you know, and this really shocked me, the worst sector, and it actually returned a negative return for those 28 years?
Technology.
Couldn't believe this. That's exactly right. Information technology was the most lagging sector out of 15 measured. It dragged the S&P 500 by almost 5.5% a year.
And do you know why it was that way? I do.
A lot of volatility when you had Priceline.com at $200 a share and it went down to $2. That's probably
in the underlying speculation of the whole .com industry.
Absolutely.
When so many of those stocks didn't even have an earnings. They had no revenue stream. They had no existence except, I've got a concept here. I'm going to put it out into the public market, and everybody's going to jump on it because we need a company that can sell dog food on the internet.
Well, and let's take it a step further, because you asked me, Mike, in an election year, you said that you hear election years may be the best year to invest. Let's go, if we take that plus this data, I don't even need this sheet because I'm a very big believer in energy. Why? I have a lot of clients. The majority of my clients are income clients. They're not people that come to me and say, Mike, here's $100,000, make it $200 by the end of the year. That's not what I focus on. I am the income guy. I'm your guy that you want your safe money with, not the speculative money. I'm a big believer in energy. Why? Because until we start driving things that are hovercraft, that don't use oil, that maybe don't use natural gas in the future, I'm going to still be buying energy. And that's what really appealed to me, being a non-stock guy, seeing that energy, even in the stock market, was the best sector during presidential election years. So It's just all kind of lining up. I mean, guys, if you go fill up your tank of gas, I mean, in the last 4 years, we've hit an all-time high in oil, even though the economy was going through some really turbulent times in 2009 and 2010.
If you're a listener out there right now and you agree with energy as a stock or energy disagree with that, we'd love to hear from you. Give us a call at 972-923-1390 or 972-938-1390 and let us know where you think the market's headed or what sector of the market you think's headed. And let's really probe into this, because I think, quite frankly, that is one of the fundamental things when you talk about investing. There are pros and cons for every business sector out there, whether it be a cyclical stock, a secular stock, whether it be healthcare, whether it be technology or whatever. It's understanding those, and it's not that the thought process you have as an individual or as an investor is wrong. It's just understanding the fundamentals there and maybe having somebody independently question your thought process. And there's nothing wrong with that. You and I have gone round and around. I happen to believe in healthcare. And I keep looking at healthcare as a sector, and I go, fundamentally, just let's think about the sheer fact that we've got people out there that are between the age of 45 and 75. We're at the end of the baby boomers going on to this wonderful thing called Medicare and Medicaid. And they're going to need some type of pill, surgery, whatever, to continue to sustain their life. And that means they're going to have more and more dollars being shelled out for healthcare. So consequently, somebody out there somewhere in the healthcare sector is going to be making money.
I'll take it a step further. You're actually demographic investing in more than healthcare. I understand healthcare because people are living longer. Why? Because 20 years ago you had a heart attack, you had a 50-50 chance. Now you're out eating a burrito 3 days later when you get after heart attack. I don't mean to joke, but
no, but you're right.
Seriously, I've heard nurses talk to me about that before. But you're absolutely right. The demographics, the population's getting older. You had the biggest baby boom, the biggest birth rate in the country, all turning 65. 14,000 Americans a day right now are turning 65. They're retiring. So they need help with their finances, they need help with their insurance, and they need help with their healthcare. That's also why financials stocks in the last year or two have been seen as gone up as well. You've had the J.P. Morgan and the Morgan Stanley do well in the market here recently, and that's because they see a lot of consolidation within the financials. Love them or hate them, but those have been doing very well here lately.
Interesting on the financials, because that's a sector that's been beaten up for so long, and you look at the diversity that you can get in that, whether you go big bank, you go regional bank, you go SNL, not SNLs anymore so much, but credit unions, one of the biggest financiers in the world, and people didn't realize this until they suddenly looked at the bailout, was GM. GM would love for you to go invest all of your hard-earned cash in GMAC and go find a way to buy Ally Bank and go buy all of these underlying things that they're trying to get for the sale of a car. But at the end of the day, I think you've got to really have a fundamental understanding of what your portfolio is meaning to do and where the opportunities are and how much risk is built in there. And a lot of people don't realize that either.
And I would like to challenge your listeners, or our listeners for this, Jim, is if you're not calling in or if you're just driving around and you're listening and you think that, let's say you're on the other side of the fence with me, that energy, it's not something I'm telling you to put all of your eggs in one basket, but energy should be in everybody's portfolio. There's a reason Exxon is the largest. They beat quarter after quarter after quarter on earnings. If you don't know how to be invested into energy without buying the stock, because maybe the stock market bothers you, how do I invest in energy, Michael, and take advantage of income within the energy sector? Either ask your financial advisor that you're working with now, or call in, email to the show, and I can give you some ideas maybe off the air. You can call our offices. We can set up a phone appointment, whatever it may be. But you need to know of the different ways to invest. And there's also very tax-efficient ways, by the way, to invest in the energy sector. So I would challenge your listeners, if it's not now, you're driving, don't pull over to write it up, but call or email into the radio station, or we have that info at Success Guys on the radio website.
Info@kbec.com.
Yep. And just say, I would like to know how to invest in energy without being in the stock market, Mike. How do we do so? I'll send you a pamphlet on it. We got a lot of literature that goes over how to do that.
Good deal. Hey, we're going to take a quick break here, but when we get back, we'd love to take your calls. Please feel free to give us a call at 972-923-1390 or 972-938-1390. We are here to help you understand what your investments are doing, how you can benefit from them, and maybe hit Mike up for some free advice. That's always a good thing, right? Nobody likes to pay for stuff that they don't have to. We'll be back here in a quick minute.
It's just one great big old jukebox filled with your favorites. Classic Texas 1390. KBEC.
Back here at Life and Money Matters with the Success Guys. Jim Phillips in studio with Mike, the illustrious Hill.
Okay. I've been called a lot of things, but not illustrious before. I feel like that's something you put on a dog's coat or something.
Before we were going to break, we were talking about the investing in specific stocks as it related to energy stocks, and energy as a strategy overall, and the fact that it doesn't necessarily even need to be a stock play. There are other opportunities. Mike, why don't you explain that to our listeners a little more of how you could invest in energy, but not necessarily have to do it in a direct fashion in like an Exxon stock?
Well, I love MLPs. MLPs stand for Master Limited Partnership, and I'm not talking about the 80s limited partnership where a salesman came to your door and you wrote a $5,000 check for some diamond mine out in South Africa. No, Master Limited Partnerships, companies like Kinder Morgan you can invest with directly. There's companies out there.
Kinder Morgan's a brokerage company.
Well, no, Kinder Morgan's actually the Master Limited Partnership. It's a pipeline company.
Oh, okay.
What they do is they go out and, for lack of a better word, not to describe everything that Kinder Morgan does, but what MLPs do in general, they're pipeline companies, and they already have the pipelines in place. If you live out in West Texas, or even some people around here, I have friends that live in Ennis whose parents have worked for pipeline companies. What they do is they have these pipelines that are already in place, and they go to companies like Chevron, Exxon, some cases XTO out of Fort Worth that just got bought out by Exxon. They go to these guys and say, hey, listen, you can use our pipeline, but we need a 20-year lease. We need you to sign the 20-year lease to use it. So we don't care if oil's at $150 a barrel or if oil's at $15. You're paying us every month just for the right to use this pipeline.
Sure. And they're using that pipeline to move crude oil, they're moving gasoline, they may be moving natural gas.
And to the holding tanks for when these companies, when price of oil goes up, they'll hold it in their supplies or they sell it and they go and they transport this oil to where it needs to go, Colorado, Oklahoma, wherever the holding may be. But I love Master Limited over these pipeline companies because they pay very, very good dividends because per structure, just like a REIT, which we've gone over before, they have to pay 90% of their income out to investors. Well, they're getting leases. And when your clients are Exxon, Chevron, and one of these huge Fortune 500 oil companies, I'm not too worried about the lease checks coming in. It's not Bill from around the corner that says, I'll pay you on Friday, even though the bill was due today. So that's what I like about them. The fact that about up to some cases, 10 to 15% of your income is sheltered from taxes because the MLPs are able to depreciate the pipelines themselves and pass that depreciation on to the investors. So these are things...
How does that work? Because they physically then own the pipeline, the MLP does?
Yes.
Okay.
That's why Exxon and Chevron and these companies have to lease it from them. And the question I always get, well, why doesn't Exxon do it themselves? Okay, well, to go from the Gulf of Mexico up to Oklahoma, that's a lot of land. And that's a lot of landowners that don't want to buy or don't want to sell their property. And I don't care who you are. So if the pipeline's already in place, it makes it 10 times easier to transport that oil, to transport that natural gas. And quite frankly, it's just a write-off to Exxon. Okay, if you don't make us pay too much, we'll keep using you. Or we'll just have to do semi-trucks back and forth to transport everything.
It's an expense to them that they can cover in their margin and their overall cost.
And again, don't forget, they already got the leases in place.
Sure.
Kinder Morgan's not going to say, well, we're sorry you had a bad quarter, Exxon. You don't have to pay us this month for the right to use the pipeline. Or we're sorry that oil is now at $10 a barrel and you're losing money. No, they have a lease just like you have a lease right here with KBEC Building. If y'all closed up shop tomorrow, the building property manager can say, well, sorry, Jim, but still need my rent. Same thing with the pipeline companies. Now, you're not going to get a lot of growth.
What happens, though, when you're the property owner as well as the station owner?
Well, then you got to be real nice to the bank if you have a mortgage on it.
Exactly.
But yes, you're getting the drift. A lot of people don't understand that it's just because there's not physical people or anything, there's not a roof over it, you still can have leases on things, much like a car lease, if you will, but now you're leasing the pipeline.
Let me ask you something completely off the topic.
I knew something was coming.
It had to come sometime today. Okay, we got this 100% portfolio.
Okay.
How much of it should be in real estate? I
feel like I'm getting set up here.
And here's what I'm looking for, okay? I was talking to a friend recently, and they said, I don't need to put any more money into the market. I don't need to put any more money into gold or whatever. He said, I've got this thing called my house. And my house was, pick a number, I forget what he told me, $250,000 house. He said, and today that house is worth $560,000, and it's paid off. And he said, I'm just going to see the appreciation on my house at 3 and 4% to be enough of a return that I don't need to do anything else.
I would tell him I've got some people in California he could call as a reference because that very thing happened in California. People, the minute we got away from that in this country, the minute you start seeing your house as an investment, like Dave Ramsey says, the minute you start seeing your house as an investment, not a place to hang your hat, that's when you start getting in trouble. I'm all for paying off your house, even in these low interest rates environments. When you get the write-off on your mortgage, I get all that. But at the end of the day, come heck or high water, if that house is paid for, you could walk in, and what do you care about the valuation? I know, Mike, I'm underwater $100,000. I get that. Maybe you're over-leveraged. But if you have a house and eventually it's paid for, and that's something I really try to push upon my retirees, let's get that house paid for. It's no longer an investment. It's, what happens in the world. I still have a place to stay. Do you really care if your house went from $200,000 to $180,000 if it's paid for and you don't plan on moving?
Only when it comes time to renegotiate the property bill.
Yeah, there you go. But my point is that's what we kind of got away
from. Property tax bill.
If you're going to do real estate investing, there's two ways to do it. You can either be a manager. I like to get what they call a 10% cap rate at least if you're going to do it yourself. What cap rate means is the rate of return you were putting in your pocket from that rental property. But then, do you really want to be going and changing an air conditioner in 110-degree weather? Do you really want to go change your air filter? That's something you've got to come to your your own kind of decision with when it comes to investing in real estate. Then, of course, you have REITs that we just mentioned.
Well, I'm going to get off on another tangent here when it comes to budgeting, because I think so many times when people look at their portfolio and they say, okay, they've got this diversity, and their house is one of those, one of the first questions I ask them is, I go, how much money do you have in your CapEx fund for your house? And they go, my what? And I said, do you have a CapEx expense for your house? And they go, what's a CapEx expense? And I said, okay, let me ask you this. Have you ever been in commercial real estate, or have you ever been a property manager? Well, no. And I said, okay, if you ask a property manager who's managing commercial property, they will tell you the single largest expense that they have is a CapEx expense. And they go, well, what is a CapEx expense? I said, it's all the stuff that wears out in your house.
Absolutely.
Okay? It's all the stuff that wears out in your business. If you're a hotel-motel operator, what do you think your CapEx expenses are? Every 3 months, you're changing out the carpet in the hallways, the carpets in the rooms that you're renting for the night, the furniture, the list goes on and on and on. And I said, if you don't have a CapEx budget for your own personal, home, I said, then what happens when the air conditioner goes out? The roof needs to be
That's your emergency
replaced.
fund, absolutely.
All of these things. And they go, well, that could be the price of the house times 2 or something. And I said, no, I'm not suggesting that you have self-insured insurance on the whole value of your home. But at the end of the day, if you had to today go get a new air conditioner at $10,000 or $15,000, where's the money going to come from?
Well, 3 to 6 months worth of expenses, at the least 3 months, 6 months worth of income needs to be put away in emergency fund. You're not going to make anything on it. I know. I get these clients all the time. Well, Mike, I'm only getting 0.1% at the bank. That's not what an emergency fund's for. And, oh, by the way, I don't have clients where their emergency fund's with me. Because if you call me, as Jim can attest to last week on a Saturday, saying my air conditioner blew out, I can't wire you the funds for my daughter's soccer. Emergency funds should be held, and the banks will love me, should be held at your banks. Right. Now, your other assets, I don't know about that so much, but emergency funds should always be held at your local bank that you could get to right then and there.
And I would argue not even so much a bank as the most liquid asset
Absolutely.
You can find out there. So it may not necessarily be the traditional bank. It could be a credit union or whatever. But the idea is liquidity. Where can you immediately go to get the cash to get your XYZ fixed, whether it's your air conditioner or whatever. So we've talked a little bit about real estate, okay, in this overall portfolio, and we both agree it's just not the house. We need to be looking at REITs. We need to be looking at commercial property, things of that nature. We've talked a little bit about energy in terms of this portfolio. Where does that 20 to 25 to 30% that we've talked about in the stock market, where does that need to kind of play out? Where does that need to create or how can we still be invested there and create diversity?
Well, we talked about that at the beginning. You said, and I totally think this is true, I think the buy and hold strategy is not a strategy that anyone should undertake anymore. I think now...
And before we get into that, let's define for our listeners the traditional buy and hold strategy. What was that in the 1970s?
Buy and hold strategy is you did your research, you looked at a stock, the price was low compared to earnings, you thought the growth was going to be good, you went out and bought it, and you held it for we're not talking 10 days, we're talking you held it for 5, 10, 15 years, like Warren Buffett says. I don't buy a stock unless I plan on holding it at least 10 years. Which, by the way, not to bag on Warren Buffett. I think there's a reason he's a multi-billionaire, so there's no way I can criticize him. But the Dow has beat Berkshire Hathaway's returns 3 years in a row, and it's on pace to lose again for the 4th year. So I think it's even being evident there in this day and age of CNBC on the TV at Subway, and with all of us having access to trade stocks from our phone, it's way too fast now to have a buy and hold strategy. News gets out there at 8:30. It's disseminated through the stock market by 8:45.
I will sum it up in my personal opinion, and this is a Jim Phillips opinion. I am not a financial planner, and if you're listening to this out there, I need to emphasize that to the nth degree. But the reality is, with hedge funds and fund managers in today's world, okay, those guys are paid to manage and make returns on money, okay? Those people have to buy and sell on a daily basis. There are more people than ever that are day traders. You've got all of those factors that 10 years ago, 20 years ago did not exist, or if they did, the cost of transaction was so high that they were doing it on a very limited basis. Today, with and again, I'm not picking on Scott Trade, I'm not picking on Vanguard or any of them, but you can make a trade for $7.
Yeah.
$6.95. So anybody can sit there day in and day out, go into the market, go out of the market, and literally start trading a stock rather than owning a position in it. And I think that's created this whole downside, quite frankly, in my opinion, to buy and hold. Because people are speculating now on the information immediately. You're not buying this quarter. You're buying next quarter. You're buying the next headline as it comes out.
Well, and I would even take one better to answer your question a little bit more directly, the 25 to 30%. If I'm going to buy a stock and you're going to make me go in a quarter into the corner, I only buy dividend income stocks that I really, really can track the earnings on. I mean, we're talking companies that are huge companies that pay very good dividend, maybe 3 to 4%, not going to wow you. But that's all I do. I love preferred stocks. I don't buy growth. Because let me put it this way. I would ask your listeners, in 2008, 2009, when you looked at your portfolio, and you probably had a meeting. If you're listening to this show, you probably have a financial advisor, or you at least know of one, or you've read enough at least to maybe know what they talk about as a diversified portfolio, which I completely disagree with. They showed you all the different boxes. What I mean by that is you have a value play. You have a growth fund. You have a dividend and income fund. You have a bond fund. You have an international. You got to have some international in there. How did all of those do in 2008? You were told you were diversified. How did all of them do in 2008 and 2009?
They all went down 10
They were
to 20%.
all down. They were all down. How's that diversified? Your average mutual fund was down 35, 40%. So you have to start looking for truer ways outside of the stock market to invest. I'm talking where it's completely separate from the stock market, where you're investing directly. That's why we've kind of talked about the MLPs and investing directly with them. I also like REITs, but the REITs that I like, you don't buy for growth. As Jim was saying earlier, when you buy a stock and it's a growth, do I put $200,000 into it and it's worth $500? Those aren't the REITs that I would buy. And a REIT stands for Real Estate Investment Trust. And there's ones out there where the tenants are Walmart, where they're Home Depot, where they're Lowe's. Those tend to be the ones that I like because they provide good income and not a lot of growth. But again, I can't give personal advice to a general listening audience. I can just throw out there what I'm doing right now with my clients.
You know, we have a caller on line.
Oh, okay.
Kenny, and he wanted to chime in here and give us kind of his thoughts. Kenny, have I got you here? Kenny? Hello?
Barely. Hold on 1 second, Kenny.
Kenny, let's try this one more time. Well, we're having some technical difficulty. 1 second here. We're not getting a...
Kenny, I hope you're not... If you're dialing from a cell phone, at least it didn't take up the minute. It's on a weekend.
Whoa, we're getting terrible feedback there. Let me try this one more time.
Where's the telephone on this side? There's no telephone. That's all right.
Well, not sure how we're going to do this here. Give us a second. Andy, you got that?
That's why we're doing live radio. But anyway, while we're waiting for Kenny, what I'd like to talk about right now going forward is my opposition to mutual...
we're getting a terrible feed.
Hello?
Oh, I just got a hello.
Hello? Kenny?
Yes, sir.
We got a terrible feedback here.
Why don't we just...
Sorry about that. Okay, we'll try and get him a second. Mike, go ahead.
Okay, anyway, Kenny, they're going to get your question real quick. I believe they're having technical difficulties. What I was going to talk about, if you can hear me, is... Can you hear me? Okay. Right now, what I wanted to talk about on the different funds to go into and things like that is the reason I also don't like mutual funds, not just the buy and hold strategy that I disagree with, is also your average mutual fund cannot be invested more than 5% into one company. So I know, feel bad for these big time mutual fund people, but God bless them, if they love the stock, they can't invest more than 5% into that stock. And let's say it's an international stock. They really can't come out and buy necessarily a Walmart in some cases. They can't buy an Apple. They can't buy a Home Depot because it's not an international stock, even though that portfolio manager may love it. So what I'd like to encourage for the listeners, if we take their calls, if not even off the air, I am offering my white paper again because last night's storms really took effect. The name of my white paper, and I didn't just make this up, it's called 7 income strategies for an all-weather portfolio. And I described the different investments that you could do held outside of the stock market that have nothing to do with the stock market to boost your income upwards to 5 to 6 to even 7%. I'm not talking 10 to 12. If anybody tells you they're going to make you 10 to 12% a year, I would love to see it and tell me how it's guaranteed, and we'll talk. But right now, 5, 6, 7% is all we should be looking for things outside of the stock market that makes up that pot.
Kenny, give us a call back here. I think we figured out what we did. I went through the wrong phone line to get that on the air. But before we get too far into this, the second half of what we want to talk about today is this whole concept of bonds. And when we come back after our break, we want to get into a discussion on where your portfolio should be as it relates to bonds. And we will be back here in a minute. KBEC. Oh, you gotta like it when a classic country station plays a little bit of David Bowie coming back after a break.
Oh, my.
No doubt about it. What can I tell you? Hey, gang, we are back here with Mike Hill in studio, Life and Money Matters, and I apologize to Kenny, our caller. Unfortunately, we picked up the wrong line. Kenny, if you're back out there, though, feel free to give us a call, and we'll get you on in a heartbeat here. Mike, let's talk about bonds. Where bonds fit in our overall portfolio, what works in bonds, what doesn't work in bonds.
This is a favorite. Thank you. You're just great question. I really want to address this because this is something that's a favorite of mine. Is right now I don't have so much of an issue of direct bonds. Of course, make sure they're what they call BBB rated or better. That's S&P and Moody's are ratings agencies, supposedly outside. We won't get into the correlation between them and these different underwriters, but they rate companies based on their sales or earnings and how much debt they have, and anything BBB or better is called investment grade. Therefore, bonds I like because if you buy a bond, it matures. Bond funds, I think, and this is Mike Hill's opinion, I think bond funds, we're on the precipice of a huge bond fund bubble. What I mean by that is right now, according to Kiplinger's in 2011, 26 to 1 inflows with 401k money is going into bond funds versus stock funds. That means for every $27 that goes in from a 401k, 26 of it is going into a bond fund, with $1 only going to a stock fund. People, your average investor is still afraid of the markets, and I think they have every reason to be. I'm not a big proponent of the stock market. But even that being said, with bond funds, when interest rates go up, the price of bonds go down. And inside of a bond fund, you don't have a set maturity. So I'm not a procrastinator, a prognosticator. We got this call right here, but I think interest rates are going up eventually. Don't know when, but we're pretty much at the bottom when you have 0.0 at the banks on 1-year CDs. So. Sure.
Hey, we've got our caller back on. How are you today?
All right, you?
Fine, thank you. I'm sorry we had that technical difficulty.
Thanks for your persistence.
Thanks for the persistence. Why don't you go ahead and give Mike your question?
Yeah, I was wondering, just starting out investing.
Okay.
So what would you think would be a good, you think energy, like you were talking about earlier?
Well, Kenny, if you don't mind me asking, what are you investing for? Is this a particular thing like a college fund, retirement? What would this investing be for? Because that definitely has a purpose.
Well, I'm 48 years old, and I'm disabled, so I'm drawing Social Security.
Yes, sir.
And I thought about trying to invest my money because you never know how Social Security can turn out the way they're talking. It's going to be ending pretty soon.
Yeah. Well, they lowered it 5 more years just the other day when it's going to run out.
Yeah.
Or become insolvent. One thing I wanted to ask you, Kenny, is do you have any kind of emergency fund? Because before you can invest, and me and Jim kind of talked about it before, you have to have somewhat of an emergency fund if life happens. I don't want to have you invested in something that takes you 3 to 6 months to maybe get out of without a penalty, and you don't have an emergency fund set aside.
No, I don't have nothing saved up yet, you know.
Go ahead, I'm sorry.
I got some for them to invest in, but as far as I saved up, no.
Well, and I'll answer your question about what to invest in eventually. I think right now, Kenny, your first plan of action is to build up an emergency fund, not an investment fund. They're two different things. An emergency fund where you have assets that you can get to, especially being disabled. It's not like you can just go pick up a part-time job at night, I'm presuming, if you're on Social Security disability. You've got to have somewhat of an emergency fund that you could dip into. Once you get about 3 to 4 months in your situation, are you single, Kenny?
No, married.
You're married? Once you get about, I'll say 4 months, once you get about 4 months worth of expenses saved up in an account that you and your wife could get to in a case of emergency, that's when you start investing. If you're going to invest in energy, the cheapest way that you could do it is if you want to use either an oil ETF. One is, the symbol is OIL, but I'm not giving you this advice because I don't know everything about your investment philosophy and where your wants and needs are. But if you're looking for very inexpensive ways just to put money in a broad energy market, there's these things called electronically traded funds. These are not mutual funds. These are just stock tickers where you could trade the entire industry. And all it costs you is the price of buying the stock. That's a very cheap way as opposed to buying a mutual fund, and it's liquid to be in the energy sector.
Do you know what we mean by, do you understand what we say by liquid in terms of the ability to trade it and get rid of it if you need to?
Yeah.
Okay. Because that's a key term there. A lot of people don't understand liquidity on a stock is not necessarily the same as liquidity in these ETFs, these electronic transferred funds.
Another one is, that would be my first step, Kenny, not knowing everything about your situation, but I would love, I've got a white paper. If when we get off the air, if you and Jim could write down your address, I'll send that to you. It's about a 10-page pamphlet that describes all the different ways to invest in energy and all the different ways to actually invest in other alternative investments outside of the stock market.
Okay, I appreciate it.
No problem, Kenny.
Thank you. Hey, we appreciate your phone call, and hopefully we can give you some good answers there, and hopefully you'll make lots of money and be able to live a nice, healthy, and wealthy life. Thank you for calling.
Thank you. Bye.
Have a great day. Well, that brings us, I guess, full circle to that. That's a prime example of understanding how your finances need to be wrapped, completely in where you are in your budget process and where you are in your income side. Because if you don't have that 5 to 6 months of emergency funds, you can't do anything.
Because what'll happen, and it never fails. Let's say you buy ExxonMobil, for example. Not saying that that's what you need to go out and buy, because you know how I feel about direct stocks. But you buy ExxonMobil, you go out, and of course, when you need the money because now your hot water heater exploded, that's when ExxonMobil, of course, sold off 20%. Now you're being forced to sell out of that investment when that isn't your exit strategy. And that's another thing that we haven't really talked about. Any investment you have, do you have an exit strategy? I see this all the time, especially with people that push mutual funds. When it's low, well, you can't sell out now. You just lost 30%. When it's high, I can't sell out now. It's going. You have to have an exit strategy on every investment, not just stock markets.
Here's your Jim Phillips test.
Okay. Oh, gosh.
When do I set the sell price?
Well, are you talking about just a stock?
When does Jim Phillips set the sales price?
Okay, on the things that I've been talking about, like in MLP, there's some cases where I will not get out of an MLP for 7-8 years based on the lease income going up. The years that the lease income stays flat, that's what, and you could look it up what year that happened.
Here's where you and I argue.
Okay.
The day I set the sell price is the day I make the buy.
That's what the
bottom line is, if you buy a stock, and I don't care what the stock is, and you buy it for $10, okay? It's a glorious day. Hey, I'm ready to make this investment. I'm ready to go. Well, the question, and I brought this up to you earlier, what day do you make money? It's not the day you buy the stock.
The day you sell.
It's the day you sell. So what you've got to do as an investor is you've got to be willing to say, okay, I'm buying it at 10, but when it hits 20, I'm selling. And the guilt is, it went to 20 in 6 days, and I only thought it was going to take 6 months, and it did it in 6 days. I got to hold it. If you were happy enough to buy it at 10 and sell it when it hit 20, don't let the time frame be the deciding factor when to get in and out.
I've got a better... Now, we bash technology.
Right.
I have. And not bash. I love technology. But here, I got one for you, and I didn't know if you knew about this. This is getting more and more popular with investment firms. All the stocks that I buy for clients, basically, they're all held at Fidelity. I don't work for Fidelity, but that's what they're held. They do have instruments now called percentage trailing stops. What I mean, you'll love this, Jim, as somebody that sets the sale price when they buy. You buy a stock at 100. You say at 10% lower than my buy price, I want you to automatically, or lower than this price, automatically sell. But what happens is every day, let's say that stock went up to 105. Now your sell price isn't at 90. It's up around 95.
97, right?
It's 10% lower than whatever the previous day's close was. So you just put in your trailing stop. Now go play your golf. Now go fish. And that would help you when you have a stock. Now, if the stock's volatile, guess what? You may be stopped out, but you're never going to lose more than 10% of your original investment that way. And also, it's a really good way to lock in gains, because typically when a stock, and this is my opinion, goes to a 10% floor, it's not done selling off yet.
Sure.
So that's why I always say 10. Some people say 8, some people say 15.
Makes perfect sense.
By the way,
that's the key there, though, is you have a strategy that says when you're going into it, when you're going to get out of it.
And if your strategy right now, if you think you are safe because you are investing in bond funds, I want you to have that person that showed it to you, or you look at it on your own and see what that fund is made up of, and you show me what's going to happen when all 1,000 of those bonds, when interest rates go up. And I would be remiss if I didn't mention this, listeners. Today is Jim Phillips' birthday. Happy Cinco de Mayo. Happy birthday. So if you flood his email, that's good. But I just wanted to wish you a very, very happy birthday. And for being a part of this show with you has been fantastic. I waited to the very end, but I had to mention it.
And I've been flooded today. I can't tell you how many people have been kind enough to send me emails and voicemails, and my cell phone's blown up and everything else, gang. Hey, today's a little bit of a different day, too, for us here at KBEC on the radio, because right at 2:55, we're going to have to get out of here and go to our baseball game, because the Waxahachie Indians are in the playoffs today, and if they win, they're going on to the second round. So we've got time for about another minute and a half here, Mike, and I want to make sure that everybody has a chance to participate in the Navarro College workshops that you're doing on May 17th, the Women in Investing. Tell me a little bit about that real quick.
I'd love to, real quick. As some of you may know, I grew up with a single mother and 3 sisters. I've been surrounded by estrogen, and now I have a wife and 2 daughters, and even our dog is a female. So what I wanted to mention is this class is very endearing to me. It's really close to the heart. This is the class that we have set up for women. It's everything you ever wanted to ask about investing, but maybe were afraid to ask. Everything that you maybe it's investing, not 101, but it's things like succession issues. What do you need to look for in insurance policies? Because right now, 66% of all wealth in the United States is handled by women, believe it or not, because guys like me and Jim are all having heart attacks before they take over. So I really, this is a community outreach that I'm really doing for women in the community. This is not a sales class. This really is just a continuing education class for women in investing. It's for women only. So mothers, bring your daughters bring your sisters. It's women in investing, and we're going to talk and answer any question that you have, and we're going to have some really good handouts for women there to get the questions asked, maybe with their spouse, with Women in Investing. Fantastic.
With that, gang, we are going to exit, and appreciate you coming in. Life and Money Matters every Saturday between 2 o'clock and 3 o'clock. We've got Mike Hill and Renee Guerra. We are here to answer your questions. We really do appreciate when we get phone calls in, and we want to be able to provide long-term answers for you to how to improve your lives and make things a little bit better. Thank you very much, and we'll see you next week.
You've been listening to Life and Money Matters with the Success Guys on 1390 KBEC. Mike Hill is a registered representative of and securities offered through Berthel Fisher and Company Financial Services, Inc., member FINRA SIPC. Hill & Associates Wealth Management Advisors is independent of BFCFS. The interpretations and organizations of these ideas are the confidential thoughts of Mike Hill and do not represent the opinions of Berthel Fisher and Company Financial Services.